Welcome to Joseph Markets, your go-to channel for all things finance, where we break down complex topics like cryptocurrency investments to help you make informed decisions. Today, we're diving deep into one of the hottest debates in the crypto world: Bitcoin ETFs versus holding real Bitcoin. What's actually better for your portfolio? If you're new here, hit that subscribe button and turn on notifications so you don't miss our weekly insights on markets, investments, and financial strategies. And remember, for 100% true news and accurate advice like what you'll get in this video, give it a like, subscribe to Joseph Markets, and drop a comment below with your thoughts. Maybe ETFs or real BTC to join the conversation. This video key points. Bitcoin ETFs provide convenient, regulated exposure to Bitcoin's price without direct ownership, making them ideal for beginners or those preferring traditional brokerage accounts, though they come with fees and limited control. Holding real Bitcoin offers true ownership, full control, and no ongoing fees, but requires managing security and wallets, which can be risky for inexperienced users. Research suggests ETFs suit passive investors seeking simplicity, while direct holding appeals to those valuing decentralization and potential ecosystem use, like DeFi. The evidence leans toward a hybrid approach for diversified portfolios, but individual risk tolerance and goals should guide the choice. Neither is universally better. Controversy exists around ETFs potentially undermining Bitcoin's core principles of self-sovereignty, yet they have driven mainstream adoption. Understanding the basics. Bitcoin ETFs are funds that track Bitcoin's price, traded like stocks. Holding real BTC means owning the cryptocurrency directly via wallets. According to the SEC's 2024 approvals, ETFs have amassed billions in assets, boosting accessibility via sources like Ledger Academy. Pros and cons overview. ETFs offer ease and security, but lack true ownership. Direct holding provides control, but demands technical know-how. Data from 2024-2025 shows ETF inflows at $37 billion per ledger, highlighting their popularity. Making a decision. It seems likely that for most U.S. investors, ETFs reduce barriers, but direct holding preserves Bitcoin's ethos. Consult professionals for personalized advice. Let's start with a strong hook to grab your attention. Imagine waking up to find your investment has doubled overnight, but you can't actually use it to buy anything or participate in the revolutionary world of decentralized finance because it's locked away in a fund. Or picture losing access to your fortune forever because you misplaced a digital key. These are real scenarios in the Bitcoin space, and by the end of this 30-40-minute deep dive, you'll know exactly which option, ETFs or direct holding, aligns with your goals, risk tolerance, and investment style. We'll cover pros, cons, real-world examples, and data-backed insights, so stick around because I'll reveal a surprising hybrid strategy that could maximize your returns while minimizing risks. Plus, I'll cite every fact from reliable sources to ensure everything is 100% verified. To keep you engaged, I'll tease key revelations throughout. Coming up, we'll explore how ETFs have attracted over $95 billion in assets since their 2024 launch, but why some experts say they're not real Bitcoin. And later, discover the shocking statistic that up to 30% of all Bitcoin might be lost forever due to poor self-custody practices, a risk you can avoid or embrace, depending on your choice. First, let's set the stage with what Bitcoin ETFs actually are. According to Investopedia, a Bitcoin ETF is an exchange-traded fund that tracks the price of Bitcoin, allowing investors to gain exposure without owning the cryptocurrency directly. These funds hold Bitcoin, in the case of spot ETFs, or futures contracts tied to its price, and you buy shares just like you would Apple stock. The U.S. Securities and Exchange Commission, SEC, approved spot Bitcoin ETFs in January 2024, a landmark move after years of rejections, as noted in Peak Framework's analysis. This approval opened the floodgates, with major players like BlackRock's iShares Bitcoin Trust, IBIT, and Fidelity's Wise Origin Bitcoin Fund, FBTC, leading the charge. By May 2025, these ETFs collectively held $94.17 billion in assets under management, with BlackRock's alone at $53.77 billion per Ledger Academy's data. This surge represents about half of the total crypto ETF market, showing how they've democratized access for traditional investors. Now contrast that with holding real Bitcoin, which means you own the actual digital coins stored in a wallet you control. You generate or receive private keys, essentially long passwords that prove ownership on the Bitcoin blockchain. No middlemen, just you and the network. As explained by Bankrate, direct holding has been around since Bitcoin's inception in 2009 by Satoshi Nakamoto, and it embodies the cryptocurrency's core principle of decentralization. But with great power comes great responsibility, as we'll see. Let's break this down point by point, starting with the pros of Bitcoin ETFs. I'll expand on each for clarity, drawing from multiple sources to give you a comprehensive view. Point 1. Convenience and ease of access. One of the biggest advantages of Bitcoin ETFs is how straightforward they are to buy and sell. You can purchase shares through your existing brokerage account, like on E-Trade or Charles Schwab, without needing to set up a separate crypto exchange account. According to Peak Frameworks, this eliminates the hassle of managing digital wallets, private keys, or dealing with cryptocurrency transfers. For instance, if you're a retiree with an IRA, many accounts allow ETF investments but not direct crypto holdings, as highlighted in the Motley Fool's comparison of iShares Bitcoin Trust to actual Bitcoin. This accessibility has driven massive adoption. Ledger reports that 37% of U.S. cryptocurrency owners now hold assets via ETFs, and 10% of new entrants choose them as their first step into crypto. Imagine logging into your stock app and adding Bitcoin exposure in seconds. That's the appeal. No more worrying about which exchange is trustworthy or navigating complex interfaces. This simplicity is especially beneficial for institutional investors who poured $37 billion into ETFs in net inflows since January 2024, per Ledger's stats. Point 2. Regulatory clarity and protection. ETFs are regulated by bodies like the SEC, offering a layer of legal safeguards that direct Bitcoin holding often lacks. Investopedia notes that this regulation reduces risks of fraud or mismanagement, as funds must adhere to strict reporting and custody standards. For example, spot ETFs use institutional-grade custodians to store the underlying Bitcoin, protecting against hacks that have plagued exchanges in the past. According to AlphaPoint, this makes ETFs a safer entry point for traditional investors wary of crypto's Wild West reputation. In fact, the SEC's 2024 approvals were a game-changer, as prior to that, only futures-based ETFs existed, which had their own issues like tracking errors. This oversight also means better tax reporting. Your broker handles the forms, simplifying things compared to tracking every crypto transaction yourself. Point 3. Reduced security risks. With ETFs, you don't have to worry about losing your private keys or falling victim to phishing attacks. Ledger Academy emphasizes that self-custody can lead to permanent loss if keys are misplaced, with estimates suggesting 20 to 30% of all Bitcoin, around 4 to 6 million BTC, is already gone forever due to such errors. ETFs outsource security to professionals using cold storage, offline vaults immune to online hacks. Peak Frameworks adds that this is a huge plus for those unfamiliar with crypto tech, as regulated custodians like those used by BlackRock provide enterprise-level protection. No more sleepless nights over wallet backups. The fund manages it all. Point 4. Liquidity and diversification. ETFs trade during stock market hours with high liquidity, meaning you can buy or sell shares quickly without price slippage. Some ETFs even offer diversification by including Bitcoin alongside other assets, though most spot ones focus purely on BTC. According to Bankrate, this structure allows for easy integration into broader portfolios, and low expense ratios, often 0.2 to 0.25% annually, like IBITs, make them cost-effective for long-term holding. Plus, as the Motley Fool points out, ETFs can trade at a slight discount or premium to net asset value, NAV, but tools like the CME-CF Bitcoin reference rate ensure close tracking to real prices. Point 5. Potential tax advantages. In some jurisdictions, ETFs might offer better tax treatment, such as deferring gains until shares are sold, per Investopedia. Direct Bitcoin sales can trigger immediate taxes as capital gains, But ETFs follow established rules for funds. This can be a boon for U.S. investors, especially in tax-advantaged accounts. Now let's flip to the cons of Bitcoin ETFs to give a balanced view. No investment is perfect, and understanding these will help you decide. Point 1. No true ownership or control. This is a big one for crypto purists. As Ledger Academy states, with ETFs, you don't own the underlying Bitcoin. The fund does. You can't use it for transactions, staking, or DeFi protocols. According to AlphaPoint, this means you're missing out on Bitcoin's full utility, like peer-to-peer payments or participating in the network's governance. It's like owning stock in a gold ETF versus holding physical gold bars. Convenient, but not the real thing. Point 2. Management fees eat into returns. ETFs charge annual fees, typically 0.5 to 1%, as per peak frameworks. While some like IBIT offer 0.25%, these add up over time, especially in a compounding world. Direct holding has no such ongoing costs, only network fees for transactions. Bankrate notes that for long-term holders, this can significantly reduce net gains. Point 3. Limited trading hours and flexibility. ETFs only trade during stock exchange hours, 9:30 a.m. to 4 p.m. ET, unlike Bitcoin's 24/7 market. Investopedia highlights this as a drawback, as crypto prices can swing wildly overnight, leaving ETF holders unable to react until morning. Point 4. Potential tracking errors and price divergence. Futures-based ETFs in particular can deviate from Bitcoin's spot price due to contango, when futures are pricier than spot, or roll costs per Investopedia. Even spot ETFs might have minor discrepancies from fees or market dynamics, as Ledger warns. Point 5. Exposure to third-party risks. You're relying on the fund manager and custodian. If something goes wrong, like a regulatory crackdown or operational failure, your investment could suffer. Peak Frameworks points out this counterparty risk, which self-custody avoids entirely. Shifting gears to holding real Bitcoin, let's explore its pros in detail. Point 1. Full ownership and control. According to Ledger's mantra, not your keys, not your coins. Direct holding gives you sovereign control. You can send, receive, or hodl Bitcoin without permission, aligning with its decentralized roots. The Motley Fool emphasizes this purity, noting no intermediaries mean full access to the ecosystem. Point 2. No management fees. As Bankrate explains, beyond occasional transaction fees, there's no annual drag on returns. This makes it ideal for long-term investors, potentially yielding higher net gains over decades. Point 3. 24/7. Accessibility and global mobility. Crypto markets never sleep, so you can trade anytime via exchanges like Coinbase. AlphaPoint adds that Bitcoin is borderless, perfect for international use without conversion hassles. Point 4. Participation in DeFi and staking. Ledger highlights how self-custody lets you engage in decentralized finance, earning yields or using Bitcoin in wrapped forms on other chains. ETFs lock you out of this. Point 5. Financial privacy and decentralization. No need to share personal info with funds. Transactions are pseudonymous. Peak Frameworks notes this appeals to those valuing privacy over regulation. But holding real BTC isn't without downsides. Point 1. Security risks and responsibility. You're on your own for protection. Investopedia warns of hacking or lost keys with no recourse, unlike ETF's custodial safety nets. Point 2. Technical complexity. Setting up wallets and understanding seed phrases can be daunting for beginners, per Bankrate. Mistakes here are costly. Point 3. Volatility and regulatory uncertainty. Bitcoin's price swings are infamous, and future regulations could impact holdings, as noted in Ledger's analysis. Point 4. Potential for loss or theft. Without professional custody, your assets are vulnerable, with historical hacks costing billions. Point 5. Tax and reporting burdens. Tracking every transaction for taxes is tedious, unlike ETF brokers handling it. Now, comparing the two head-to-head, for convenience, ETFs win. For control, real BTC. Data from 2024 shows ETFs tracking Bitcoin closely, with minimal errors, but direct holding captures 100% of upside without fees. Ultimately, what's better depends on you. ETFs for passive regulated exposure, real BTC for active decentralized involvement. A hybrid. Allocate 70% to ETFs for stability and 30% to self-custody for utility. In conclusion, both have merits, but weigh your needs. For more like this, like the video, subscribe to Joseph Markets and comment your pick below. Thanks for watching.